Hey everyone, it is Tuesday the 10th and shooting this about 2:30 in the afternoon. What I wanted to do is spend a few minutes going through the world production numbers and the balance sheets as we look forward to Thursday's USDA report and really just the rest of 2023. And then tomorrow we'll shoot another video for Market Chat that digs into the technicals and really analyzes what the charts are doing. And if you've been watching price action the last few days or weeks, what you've seen is kind of a different emerging pattern than what we're used to over the past couple of years, which is for the past several years, anytime the markets have rallied, they seem to reinforce that with more buying, and every time we start to sell the markets off, the sell-offs are short and swift, and then they get bought. And what's happening now is the opposite, where rallies are getting sold, and you just can't really sustain any upward momentum. You know, today we saw corn trading up 14 or up 12 or something like that. Then it just ended up getting sold, and same with beans. So, and I think that this video will help put a little bit of that in context. Now, before we dive into the numbers, what I want to do though is warn you and share with you that this is extreme. What I want to show you are the extremes of what might happen in 2023, because the way we view the world and our role on your marketing team is to identify potential massive downside variables that if they become true, that we will see much lower prices across the grain complex. And so our job is to identify those and say, hey, you got to be aware of them and you've got to be active. You know, and that's a little bit different for those of you that have only been with us for a couple of years, because because in 2020 and 2021 and 2022, we've been much more bullish because we felt like the pressure was on the production side of things, and we had to produce enough bushels worldwide in order to meet demand. And so we've been encouraging people to stay long, and really be patient with the market. You know, that has shifted, and the reason for that is what I'm about to show you. And I think we've been clear about that and talking about it for several weeks, but let me try to highlight what it is that we're looking at. Okay, so right here in this corner, what we have are straight from the USDA reports on global production of corn, soybeans, and wheat. And this is all classes of wheat, not just Kansas City, okay? And what I want to point out here is the consistency on the number. So we just went through a year with a bad drought here in the US, and we ended up barely moving the needle at all. I mean, we were down 13 million metric tons total, but really we've been pretty consistent with our production, okay? And if you look forward, the USDA is looking at higher production than we've had in the past several years. Now, same with soybeans and same with wheat. In fact, you can see wheat just gaining more and more acreage. Now, the world ending stocks, which is ultimately what prices globally are derived by, have also been pretty consistent. And that's what I want to show you. You know, in 2020, when we had all the demand come in August of 2020, you know, we only dropped the corn carryout by just under 30 million metric tons, which is just 1 billion bushels in corn. And now we've replenished that and put some of it back on. Now the USDA is only showing a slight decrease on world stocks for the upcoming year versus this year, but still above the lower year, or above the lowest year, which was 2021. And what you're seeing over here on this line are the stocks to use ratios. Okay, so for each one of these years for corn, the stocks to use ratios really have not been beat up too bad, and what we're starting to see is a slight uptick, which means that higher prices have curtailed demand, and they've also incentivized production. That's the key. High prices incentivize production and curtail demand, and if we end up with too many bushels, then the opposite has to start taking effect, which is we have to start we have to start discouraging production and increasing demand, and we do that with lower prices. So graphically, this is what we're talking about with corn, right? Really pretty consistent production numbers and a very consistent carryout. So we really haven't had the massive swings that you would have expected with a doubling in price. So that tells you that the shortages have been domestic, not global. Okay, and that's an important point to make. Soybean ending stocks, they look like they're on the rise and are pretty stable. Corn ending stocks look like they're pretty stable to on the rise. So all of these global numbers are saying we have plenty of food. And that is a different tone than we've had for the last couple of years, because we've been worried about famine and drought and all those kinds of things. Say, okay, so Tim, you're saying that everything's been pretty consistent and the world's not in that big of a problem. Well, we all know that the world ending stocks are really all just in China, and that they're lying to us about what those numbers are. Well, that might be partially true, because certainly China can manipulate their numbers, and this is inclusive of China. But that doesn't mean that that we won't trade it, and that the market won't work itself off. So just because we're skeptical of China, which we all are, doesn't mean that we can't use it. Well, what about Ukraine? Well, hey, this is all in there, and at this point, all of those numbers are well known and pretty baked in. And you say, well, what about production? What about production in Argentina for corn and soybeans? Aren't they way high? Well, those numbers are caked in here too, because you know, the USDA is currently assuming a number smaller than what we think Brazil will be, and bigger than what we think Argentina will be. So really, it'll be kind of a net, or actually a slight increase based on what the USDA's attaché out of Brazil is telling us today, which is 153 million metric ton crop, with expectations of exporting 96 million. So that is just a massive crop coming out of South America, and we can't talk about it too much. So what does it mean for our balance sheet? Okay, so this is our balance sheet, and as the USDA has represented it to us straight from the USDA reports for each month, okay? And this is what our forecast might look like if we plug in some different numbers. Now, what we're going to get on Thursday will not have these numbers in it, because it's going to use last year's numbers, okay? It's kind of weird the way the USDA does this. It doesn't move to new acreage and new yield estimates until May. Which is why these charts tend to start in May and look forward. For now, we use last year's numbers. So what we're going to do is just ignore it and jump ahead. So we're going to take our ending stocks number, and we're going to plug that into the beginning stocks for the next year. And then what we're going to do is we're going to add an acreage guess. We're going to keep our harvested acres the same at 92% of normal, of planted, which is about normal. And we're going to return our yield to about trend line, which is going to be about 180 for this year. That leaves you with a 15 billion bushel corn crop. Assume we import 50 million. And then let's assume that the USDA is slightly low on demand, and that we're going to be at 14.175. That leaves us with a carryout of 2.2 billion bushels for next year versus 1.257 for this year, or a much, much loftier and burdensome stocks to use number at 15.5%. So we are currently trading a much lower carryout than that at 650 corn. And if this number is to be true, then we are looking at much, much lower prices. Now, okay, can it be worse than that? Well, yeah, because currently we're talking about 93 million acres of corn. And if we have great weather or a return to normal, where we aren't burning up the Dakotas or, you know, the Western Corn Belt, and we have a normal year, and let's say that the USDA is off a couple 100 million bushels of corn because of decreased demand worldwide, then now all of a sudden we're at an overwhelmingly burdensome near 3 billion bushel corn carryout and a stocks to use at 21%. Now, the reality is that the market's job is to not let that happen. Okay, so as a futures market trader, you have to be aware that the role of the market is to get ahead of these future problems and discount them now. And so if as soon as this market starts to recognize that either of these is a possibility, then it's going to go discourage the production of corn, and it's going to do that with lower prices. Because if the demand number is coming down and too low, then we have to make ourselves more competitive, and we have to create demand, and we got to do that with lower prices. Vice versa, if the production number is too high, then we must discourage production, and we must do that with lower prices. Because if we end up with this much of a carryout, then we have a whole new set of issues that we've got to deal with. And so I don't think that that's a realistic outcome, but I think that the market has a job to do over the next several months in order to discourage this from happening. And this is why I think we're starting to see corn get sold on rallies rather than bought, because we're shifting our mindset away from this tight carryout to something much more burdensome, and we just don't want to let it get overly done, but somewhere probably in that 12 to 14% is where the market would probably like to price it in, but it's not going to let it get to this number. Now, so you're going to say, well, hey, the bean carryout is really tight, and we're going to go ahead and we're just going to plant more beans, right? Because that number's good. So corn can go down, beans stay where they are or go higher, and we just shift a few acres. Well, here's why I think that that's really not going to happen either. So if we hold our acreage in beans identical to what it was 1 year ago, but we just add 2 bushel an acre to the yield, okay? So same exact setup, and we hold demand the same, we end up with a much higher carryout number, okay? 220 to 324. That's not overly burdensome, and it's not $6 soybeans, but it's not 15 either. It's probably somewhere in that 11 to 13 range, somewhere in there. And November is currently trading at at 13.95 or whatever we closed at today, and March is trading at 14.85. So you got a couple of dollars of risk on this neutral case. But what if we start planting more acres? But even bigger, this is the problem that I think beans have. What if we hold the acres the same, but Brazil does have this monster crop that they've been talking about? And if Brazil's crop is 153 and they export 96 million metric tons, then that's going to overwhelm the world supply. And so our market is at risk of losing, let's just say maybe 30% of that, or maybe 10 million metric tons, which is about 300 million bushels. That balloons our carryout to over 700 million, or a stocks to use of 17.88%. Just like corn, that number is too extreme relative to this. So beans don't have any room to pick acres up from corn. That's what I'm saying, is that beans can't stay high to buy acres, because then it will create them a problem for themselves. So where do the acres go? Well, likely they're going to go to a lower cost alternative, which would be like wheat. So the wheat acres are already up this year, but if you look forward to lower corn prices and lower bean prices, then what's going to happen to wheat? You got it. It's going to discourage production as well, because of the balance sheet that I just showed you that says we have a 52% stocks to use looking forward anyway on wheat and continuously growing production. We don't need more wheat acres on planet Earth. We've already got enough, because wheat's being grown everywhere else. And if our weather patterns return to anything close to normal, then we don't need any more wheat either. And if we do end up with it, then we have to be the cheapest in the world in order to increase demand. So no matter which way we look at this, the bearish case for corn and soybeans does not bode well for a bullish acre war moving into 2020, moving into the next few months, which is the whole point of this video, which is to suggest that, hey, The recipe is intact and in place for much lower prices in the next few months versus where we've been. Now, you're going to say, hey, Tim, we all look at other people. We read other information that's out there too. And we see famine in Argentina. We hear all these numbers, and the other analysts aren't anywhere near as extreme as this. And I will tell you this, I read them too, and I understand where they're coming from, and I understand where they're at. But I will argue to you that they just haven't done it yet. And the reason is because they would rather get your subscription than manage your risk. And our job is to manage your risk and say, hey, this could happen, and so we need to be defended. Remember, we don't have any dog in that fight. We don't make any more or less when people buy puts. We have no commissions that we're trying to earn money off of. Our job is to say, hey, we need to defend your balance sheet, and we need to make sure that your revenue is going to be enough to cover the high expenses that we've got, because it might take a year or two for those expenses to come back in line as the market readjusts to these bigger ending stocks. Okay, so what's the bullish case? Well, what is it? Well, the bullish case is drought. Just plain and simple, the bullish case is domestic drought. It's got to get hot and dry in Iowa. We've got to have a similar yield to last year. We've got to have more demand than what the USDA is saying. And at that point, we're still trading a looser balance sheet than what we had a year ago. So listen to that carefully. The same drought situation as 2022 with more demand than the USDA is talking about yields a balance sheet that's still looser than a year ago, which means that we still have lower prices, although marginally lower compared to either one of these two scenarios. So the bullish case doesn't reward us with higher prices or with a huge acreage battle to come, because we can plant 93 million acres, we can grow 173, and we still have a 2.2 billion bushel carryout. So the market's got a hard job to do moving forward here. It's got a very difficult rebalancing to handle, and it's got to discount a lot of future issues. Now, if we do break and we go down, that doesn't mean we stay down there forever. It means that the market's just got to recorrect itself. So for those of you that are kind of new to this, anytime you see a scenario like this, what it should tell you is, hey, I need to protect myself. And you can do that in lots of different ways, whether that's with puts, whether that's with a hybrid strategy or a multi-leg strategy, whether that's with cash sales, basis sales, whatever the mechanism it is that you want to use, you can tailor it so that you can sleep at night knowing that, hey, if I'm wrong and we do get a big drought and we rocket this thing higher, you can still capture that without risking the whole farm balance sheet, okay? All right, that's 18 minutes. That's a little bit longer than I wanted to spend on it. I hope that's helpful. Again, I'm intentionally trying to highlight the downside here because we do have objective fundamental reasons for why we are suggesting that everybody be hedged as early as we are, because we think it's a hedge first, adjust it later year, rather than be patient and hope for higher prices like we have been the last couple times. We just don't see that same recipe unfolding that we've had the last couple years. Remember, there is risk trading futures and options, and if you need any help or questions, please reach out to us, and please consider your own financial condition before you trade. We will talk to you guys later on. I hope you guys have a great night.